The United States possesses the most powerful economic engine in human history, but looking closely reveals that this machine is secretly running on fumes. Macroeconomic data supports this dominance. The stock market consistently reaches new highs, and the top tier of households currently holds $55 trillion in wealth, nearly a third of all the money in the country. The common average metric masks the true state of the middle class. While the average savings account balance is reported at $62,410, wealth in this country is distributed as a severe cliff. A small number of very wealthy households inflate that data so heavily that it hides the actual holdings of a typical family. High-level statistics used to declare international economic victories work as a shield. They cover the fragile reality of the citizens who are actually powering the engine. This chart contrasts the $62,000 average against the actual median emergency savings in America. The true midpoint for the country is exactly $500. Currently, more than half of all Americans cannot cover a $1,000 emergency with their savings. That $500 acts as a load-bearing throw pillow rather than a safety net. It is often entirely consumed by a single set of tires or a plumber's visit on a Sunday night. This fragility is the statistical norm for the working middle class. Most households with steady jobs and benefits are now a single busted appliance away from a credit card balance they cannot pay off. The data shows a stark reality. The most powerful economic engine in the world is mathematically operating on the absolute brink of personal financial collapse. This fragility is a feature of the financial system. To a bank, an $11,000 credit card balance is a meticulously engineered product that generates reliable, compounding revenue month after month. Over decades, revolving debt has been normalized into a permanent utility bill for half the country. Credit reliance is now an expected part of an average American budget, with nearly half of cardholders carrying a balance month to month. This area chart shows the math of a 23.6% APR. Making only minimum payments on an $11,000 debt requires 22 years to clear. By the end, the borrower will have paid $18,500 in interest fees alone. That debt balance is a calculated 2-decade revenue stream for the bank. The business model relies on the specific gap between a monthly payment that feels manageable and the compounding interest accumulating beneath it. The auto industry uses a similar strategy to hide explosive asset costs. The average car payment is now a record $772 per month, sustained by extending loan terms to 84 months, or 7 full years. This cycle creates a perpetual debt trap. When a buyer owes more than their car is worth, a state called negative equity, dealerships simply roll that underwater balance into a new, larger 7-year loan. Buyers often focus on the monthly payment, while the total life cycle cost of the vehicle balloons. Financing a $52,000 truck at today's rates can easily result in paying $64,000 for a vehicle that will be worth less than a third of that when the loan finally ends. The average consumer is effectively cannibalizing their future wealth to finance their commute, trapped by the illusion of monthly affordability. This bar chart contrasts average lifetime earnings against the cost of the American dream. Basic goals like home ownership, 2 kids, and retirement now cost roughly $5 million. The average college graduate will only earn $2.8 million over their entire working life. This gap is the result of a massive shift in leverage. In 1965, the CEO to worker pay ratio was 21:1. Today, that ratio has reached 281:1, with executive compensation growing 40 times faster than typical wages. The modern economy absorbs the value of worker productivity and returns a monthly payment instead of equity. When corporate profits climb, those gains pool at the top, while the workforce faces rising costs for the same basic stability. The lifetime cost of a middle-class life now exceeds average earnings by millions of dollars. For the 70s, this fragility is the accumulated result of business models that prioritize extraction over long-term resilience. Policy choices have allowed a system to develop that benefits property owners and lenders at the direct expense of the people paying the bills. America's global financial supremacy is dangerously leveraged against a population that can barely afford to exist within it. Changing the outcome requires recognizing that default settings like minimum payments and 84-month loans are engineered specifically to extract the maximum amount from you. These systems prioritize a business model over your financial resilience. This line graph shows the power of making contrarian choices, redirecting the $600 a month typically spent on high-interest debt into a compounding investment for 20 years turns a permanent liability into nearly $700,000 in wealth. The system is structurally rigged to favor the house, but individuals can still choose to opt out of its most toxic defaults. Success comes from knowing the numbers and refusing to participate in the standard debt cycle. To understand the hidden power behind money, like this video and subscribe to Dollar Logic USA. Somewhere right now, an average, fully employed American is sitting in a Walgreens parking lot, doing math in a Notes app to figure out if they can afford an $840 car repair without triggering a financial crisis. Meanwhile, the U.S. macroeconomy constantly sets new records. Trillions of dollars trade daily, corporate profits are climbing, and the dollar continues to dictate global trade terms. This chart tracks the U.S. personal savings rate, which has dropped all the way to 4.6%. At the very end of that downward trend sits the actual median American household, holding exactly $500 in emergency savings. The global financial system relies on this extreme domestic fragility to function. Statistical reality shows that 59% of Americans cannot cover a $1,000 emergency using their savings. In this group of 100 typical Americans, 59 fade out when hit with a $1,000 bill. Federal Reserve data reveals the math is even tighter for others. 37 of these people, nearly 40% of the country, cannot absorb even a $400 emergency using cash. These figures represent routine life events, a set of new tires, a plumber fixing a water heater, or a sudden medical copay. This widespread inability to absorb minor financial shocks provides the actual, highly leveraged foundation for the most powerful economy in human history. Financial institutions treat the $18.8 trillion mountain of U.S. household debt as their primary product. That average 11,149 credit card balance functions as a 22-year revenue stream for the bank. By making only minimum payments, the cardholder generates over $18,500 in pure interest, paying back nearly triple what they originally borrowed. The auto industry employs the same strategy. Dealerships push 84-month loan terms to make the monthly payment appear manageable, even as the total cost balloons. This traps the buyer in a red zone where they owe more than the vehicle is actually worth. When it comes time to trade in, that negative equity often rolls directly into the next vehicle loan. The consumer ends up financing a new car plus the remaining balance of the one they no longer own. This compounding loop is a highly engineered strategy designed to extract wealth from the middle class month after month. While debt extracts cash, structural changes block asset ownership. Affording a median-priced home comfortably now requires an income of over $141,000, yet the actual median household earns roughly $83,000. Saving a standard down payment in this environment requires decades of perfect, uninterrupted discipline. In major tech hubs like Seattle, that savings timeline now exceeds 22 years. This line chart traces the shift in corporate compensation. Since 1978, typical worker pay grew by about 26%. In that same window, CEO pay grew by over 1,000%. As productivity rose, the financial gains stopped flowing down the organizational chart. Many individuals turned to doom spending to cope with this lack of leverage, buying small luxury goods to find temporary relief from macroeconomic anxiety. The rules of the economy were quietly rewired over 40 years, ensuring that standard hard work is no longer mathematically sufficient to get ahead. This $18.8 trillion debt engine provides the primary fuel for global corporate profits and Wall Street margins. Central bank policies dictate these profit margins. When rates rise, banks pass the cost to credit card holders almost immediately. When rates are cut, they move slowly to lower consumer costs, protecting their spread. Deep structural instability is emerging. Auto loan defaults are hitting 5%, and nearly half of all credit card holders have zero plan to pay off their balances. The multi-trillion-dollar global financial ecosystem currently balances on the fragile $500 savings cushion of the American consumer. Consider two distinct financial futures for a median American couple earning a combined $113,000. In Path A, the couple accepts every default setting. They take the 84-month truck loan and pay only the minimum on their credit cards. By age 55, they arrive financially trapped, constrained by debt, and vulnerable to any emergency. Path B rejects the defaults. They buy a used vehicle, kill high-interest debt, and automate investments. This chart shows the dramatic net worth divergence. By age 55, compounding interest pushes Path B to nearly $700,000, providing genuine life options and security. This massive wealth gap results from the deliberate decision to opt out of the financial industry's extraction machine. Knowing that this trillion-dollar business model is designed to drain your resources is the only real defense. You must recognize the rules of the game and override the default settings, the minimum payments, the long-term loans, and the auto-renewing subscriptions that keep households broke. The math of the global economy changes in your favor as soon as you stop feeding it. If you want to understand the hidden power behind money and the global economy, make sure to like this video and subscribe to the channel Dollar Logic USA.